Hey guys, what's up? Stock Retail coming back at you. Hope you're having a great Thursday. Always a fun day for us who love the movies. Usually a day when we get some new titles and or a chance to go kind of get your weekend started early and see some things that you've missed so far. So I hope you're all out there having a great Thursday. Where I'm at, it's certainly a beautiful day out. I'm sitting at my window looking out at the sun. I'm having a great day. Hope you are too. As you can see today, I'm going to dive deep into the Q2 earnings. So I do a backwards look every time we have an earnings call. I've missed one or two, but people who are longtime followers of mine know there's a scorecard I call the Fudbuster, or it's just in business, you have something called a balanced scorecard. And so I like to look at a variety of metrics from the income statement and the balance sheet, take a look at how we're doing, and what that does for me is, the shills like to maybe call me a hype guy or whatever because I do love AMC and I do believe we're going to win and I am here for this fight. And so there is a certain amount of hype there. But what keeps you from being, all hype and no substance is sticking to the numbers, letting the numbers tell a story. You guys know that I say facts over FUD. So today I'm going to review the facts. We'll take a year over year view of our earnings and see how we're doing. I'm going to show you a couple of metrics. In fact, one brand new one. I'm going to show you a slide I made for everybody. You guys know that I continue to just sort of obsess AMC's numbers and try to see how we're doing. And I think it's important in light of people who constantly try to spin negative narratives at you that you see how the business is really doing with the hardcore fact checkable numbers. So without further ado, let's just dive in. So I know this is maybe an eye chart, but I'm going to go through this one little piece at a time. We're going to unpack this. This is what I call the Fudbuster. You would find that it got its name all the way back in 2021 when Jim Chanos was coming around and attacking us. And I said, fine. He tried to take the view of, oh, this is some guy in his mom's basement kind of thing. And I say that, with a smile on my face because I think we all embrace some level of kind of being autists out here, right? I can hold longer than you can stay solvent was always the thesis and still remains. And that's why we're still here. Side note, I don't know if you saw today, there is a person I had called a shill by name, mostly from the GME community. Actually, not really part of the community. I was warning GME that he was there to cause division. He was kind of attacking Ryan Cohen now and then, and I was warning the GME community and the Bitcoin community. Anyway, he took a shot at us today, trying to say that retail has left AMC. And so if you look at my X, you would see I posted, remember in the earnings call, Adam said 1.7 million of us have signed up for Investor Connect. So we have almost 2 million people alone signed up for Investor Connect. And, that is going to be only some percent of actual shareholders. So we still, for sure, have, millions and millions of shareholders. So that was kind of fun to see. But anyway, so the Fudbuster was for people like that who like to come and spread these negative narratives. You would find my first one on Reddit way back then. I'm stock underscore retail on Reddit. Got a lot of things in 2021, 2022 out there. Anyway, so that is the origins of this. But then just quarter over quarter, time after time, I have been updating this slide as a way for us to track how we're doing, sort of refute the folks who like to say we don't know what we're doing. I mean, these are definitely business metrics, ways that folks would look at a business, see how we're doing. And so I'm going to walk you through this, and as I do, it'll give you a little insight into looking at income statements and balance sheets as well. I always say eventually I really want to do like an educational couple of videos on how I look at all that, and we'll do that someday. All right, so anyway, let's just go through this. The first thing, if you'll recall, I mean, if the point was I can hold longer than you can stay solvent, well, we needed AMC not to go bankrupt, right? Our whole thesis falls apart if AMC went underwater. And that is one of the reasons, by the way, probably the number one reason that I continue to have faith in Adam is if you think about the storms he has navigated this ship through, all of COVID, and remember too, in 2020, there was no ape movement. And so he had to survive, 2020 without, and I'm going to show you actually a view to kind of where AMC's revenues were. But anyway, so he had to, make AMC not go bankrupt all of 2020. Then, of course, 2021 was still a slow grind to opening back up. And then we had the strike, right? So he has kept us liquid. And that's why I measure our liquidity. It's can you pay your bills? Are you going to stay solvent? And when we say I can hold longer than you can stay solvent, the point is AMC is going to stay solvent and I can wait and hold my AMC position. Meanwhile, the shorts over time are going to get pressed. That was always the thesis. And so one of the things on here that we continue to measure, I continue to measure, I should say, I don't, you guys, I just use we language. I've gotten asked that before, like, who's we? It just kind of comes out of me. I suppose it's from my 21 plus years at Nike, right? Like you feel like you're part of this team. I feel like I'm part of a team with all the apes, with the retail shareholders who are fighting the machine. So if I ever say we, that's where that's coming from. But I measure our liquidity every quarter because that is a sign, a mark of um, are we able to keep holding or are we in trouble, right? And that is why that's front and center. So, okay, let's look at it. So I look at our total current assets, and you can see that that's $709 million. I guess that's pretty easy to say we're doing okay. So this includes some things like our, accounts payable accounts receivable. This includes accounts receivable. We'll talk about AP versus AR in a minute here. Um, anyway, so this is not just our cash position, just so you know, but this is our just kind of current assets, which is sort of a mark of your current liquidity. Forgive me, I'm going to take a quick drink here. Since I'm not live, this is maybe a boring thing to share, but so I'm drinking some zero sugar Canada Dry that's got the real ginger in it. It's pretty good actually because that real ginger gives it some good flavor. So there's something real boring for you about what I'm doing over here. All right, so we got $709 million current assets, or I'm calling that our liquidity. Now that is down year over year, but here's what I want you to notice. So notice this, we're at this minus 19%. I'm gonna hover so you can see where I'm looking. Minus 19% year over year, but we also have paid off $702 million of debt in that year. That's just from our borrowing line. If I was to look also at our deferred leases, our deferred rents that we had paid down, our number is bigger than that. And Sean gives that number every earnings call. I just don't remember what that is off the top of my head. So we paid something more than $700 million down on our debt. In the meantime, kept this $700 million of liquidity currently. So that's a pretty big deal. And then remember, we've been investing in the Go plan. So that is going to reduce your cash position a little when you start making investments. And so what I'm suggesting is just green here. I've marked it. So I give it these arrows of like, where are we going? In this case, I'm kind of calling that flat. I understand we're down double digits year over year, but I would just also say we don't necessarily need to have, 800 million plus in our liquidity right now, especially now that our cash flows are starting to improve, which you're going to see on here. As our cash flows get more and more, we get stronger and stronger. As our debt load gets lower and lower, AMC won't need to carry quite as much current liquidity. And so that's why I'm not calling this down per se, and I am calling it green. Hope that makes sense. All right, so let's look at attendance. Obviously, a very key metric for AMC. You'll see that I am saying, hey, there's a minor downtrend, and we're going to talk that through a little bit. But that's going to be offset by the strength of our business and the Go plan and where these guys have been investing. And so we'll let the numbers tell that story too. So we are up 26% year over year. Now, you got to remember, I am comparing to a somewhat strike-impacted quarter last year. Remember last year when I kind of said, okay, we start to improve with, I think it was maybe when Inside Out and some other, Twisters. And I don't remember what all movies kind of at the very end of Q2. So probably kind of like May, June last year in 2024, we started to improve, but it was still somewhat strike impacted. So that is a smaller quarter. And you can see then that we're up 26% year over year on our attendance. But what I'm noting and why I'm calling this kind of a downtrend, we under-index the box office. So here's where, I make sure I stay out of hype. I show you guys the real numbers and we talk it through and we say, how do we feel about this? So the box office was up 38%, AMC's attendance up 26%. So you got some leverage in there. We're going to talk about how ticket prices were up, food and beverage spending was up. And so you'll see that our growth in revenue is better than just our attendance growth, right? So there's just there's going to continue to be a mix. Now remember then, Q2, we didn't have our half off Wednesdays yet. So I just have a feeling when we report Q3, we'll see some nice gains maybe in our attendance. Let's take a look at that. relative gains, I should say, because Q3 this year versus Q3 last year is a little smaller at the box office, but that's for another video, another time. But anyway, so great to see strong double-digit growth in our attendance. You can see driven a little more in the U.S. than internationally, and that's maybe what's dragging our growth number down a little. Then let's go to food and beverage. So now you start to see everything starts to look real green. So food and beverage, 36% gain on net revenue. Going all the way back, I measure our total net revenue on food and beverage. And the reason is early on, I was showing our growth in food and beverage, and someone said, yeah, but inflation is certainly making people pay more to AMC, but isn't inflation also making AMC's expenses on food and beverage go up? And so I track our net so we can see how profitable is this business. Did we grow our profits? That's what you're seeing here. So food and beverage, 36% growth on our net revenue, how much we got to keep. It is a little bit down on the margin. I measure our margins on food and beverage every time as well. As you can see, year over year, minus 0.2. But our margins are still amazing on food and beverage. So I would definitely still call this green. We're still tracking at relative highs if you look at the last few years. It's just this time last year was a little bit better. And you can see we grew $106 million of net revenue. Bottom line, we got food and beverage grew us $106 million year over year. And by the way, that's an all-time high. Our total revenue was almost, if we just had a little bit more, we would have hit 500 million. So you can see we're at 499.6 million on our food and beverage revenue year over year. Great growth there. I think that was also maybe an all-time high. Weren't we 80? No. We were 790 something. I'd have to go look. In food and beverage spending per person, maybe 795. I don't remember. Anyway, so great growth in food and beverage, and Adam talked a lot about that in the earnings call and how the menu is driving that. We don't just have popcorn and candy anymore. Now we've got pizza and hot dogs and donut holes and pretzels and mini pretzels and just all the things. The Dippin' Dots. So food and beverage business looking great. So admissions. All right. So now we're kind of tracking a little more commensurate with the box office. This is what I said, that you're going to see some leverage. So yes, we only grew 26% on attendance, but you can see our total ticket sales grew 35%. That's pretty close to the box office growth. Box office grew 38%, the domestic box office. Our admissions grew 35%. You could probably say the difference is that kind of lack of international growth. I know Adam has said there's some competitors in the UK in particular who've been kind of really aggressive with their pricing. So I don't know what's going on there. Or perhaps, think through too. We've also closed some properties over the year, and that's certainly going to drain you. If you don't have those properties, you don't have those those attenders, right? So what I'm suggesting then is our admissions growth, fantastic. Almost $200 million admissions growth. 35% growth. You can see our ticket price growth was 8%. We grew our tickets per person by 84 cents year over year. That is significant. And, I would say that's starting to show elements of the Go plan, right? So if we're increasing our premium screens, those tickets are more. If we're increasing the amount of screens where we have better seating, Adam and team had, given us updates on some of the improvements to seats, laser projectors, premium screens, all of that. It's showing up in the ticket price that AMC in some cases is becoming a premium location. So that's pretty cool to see. I do believe it's working. The team, I just trust them to balance this price seesaw between having as much attendance and total revenue total profits as you can versus becoming this premium brand. There will be some people who are priced out, right? Not everybody is going to pay to see IMAX or be in the luxury seats. But now I think with Q3, like I said, it's going to really show when we've got this, half off Tuesday, half off Wednesday business model. I'm real interested to see if now we capture both a high-end consumer and a discount consumer. Might really start to supercharge our revenues. Let's just wait and see on that. And I trust the team to decide if that's working or not. So we'll see. All right, so let's look at assets versus liabilities. Now, the first bucket here, this comes from the balance sheet. The others since then, I've been looking at the income statement. Now we're back to the balance sheet. So assets versus liabilities, these are on the balance sheet. You can see I'm calling us kind of a neutral or a flat. We are, what I'm doing is I'm just think of a fraction, the numerator and the denominator, right? So in this case, we would like the number to get bigger. What that would mean is our assets are growing as a percent compared to our liabilities. The assets are the numerator, the liabilities are the denominator here. So just being open and transparent with you guys, we went sort of the wrong way here. However, we can easily unpack this one too. That's why I'm calling it neutral, not red and not yellow. We are down in our assets versus liabilities year over year, but I took a look at what's driving that, and I do believe it's basically just closures. So as you close, in your assets, there are two lines in particular. One is property net, one is kind of your lease. I'm forgetting the exact language of it, but in effect, it's sort of the value of all of the leases that you have and your ability to use those properties and all of that. So uh, the closures have reduced our assets a bit, but now think through profitability, right? So that's why we look at a balanced view. We look at both the income statement and the balance sheet. So the balance sheet is telling us, hey, your assets went down. But then we look at the income statement and we say, well, yeah, but we're more profitable now because we closed down less profitable properties, right? And then over time, as the revenues come back to the box office, you're going to see, as we bring in more cash flows, then your assets are going to increase. So in terms of a future outlook, I'm unconcerned about this. You're going to see this going the right way. And then keep in mind, we paid off a bunch more debt in July, which is Q3 and does not show up here. So if I was to reflect our other debt payments, what would happen is then that denominator, that liabilities, got smaller by $143 million and actually brings us back to where we were already, even without improved cash flows. So this one, I'm not worried, but I just, I'm committed to transparency, showing you guys the numbers. That is where we are for our assets versus liabilities measure year over year. Another thing that I just personally measure is our operating expense as a percent of our revenue. What I'd like to see over time is we are growing revenues faster than we're growing expenses. So if our operating expense as a percent of revenue goes down, or if we see improvement, in other words, that's going to reflect here. And so I show you guys that every quarter as well. And you can see, sure enough, year over year. Now, granted, Adam has talked to you about operating leverage, right? Many times. And so as the box office grows, and what did I tell you? Last year, this was a bit of a strike impacted quarter, Q2. And so it's just natural that the box office grew, I told you 38%. You ought to see some leverage there, and you do. So this is going to back up what Adam's saying. All right, so we improved our operating expense as a percent of our revenue went down 9%, but that's an improvement. That's why this is green. You want that to go down. This is like a golf score. The lower, the better. So we were at 92.2% this quarter last year and 83.6% this quarter this year. So you got a number from Adam and the team in the income statement and on the earnings call that was cash from operations, basically. So what was the net contribution from operations? If you just take our revenue minus our operating expenses, hopefully you're positive, right? So anytime this number is below 100%, we're operations is contributing cash. In other words, the effect of having your doors open was positive. This, by the way, was our number 3 result for the entire post-COVID era. I believe the best two were those 2 quarters in Q3 where we were profitable. We turned to profit those 2 quarters in Q3. One was, I think, I said Q3, I meant 2023. So pre-strike, we had the Mario quarter, we had the Barbenheimer quarter. Hopefully I'm remembering those right. And we turned a profit. We had positive cash flow. That was a lot of fun. And then the strike hit, right? I mean, just think of all that's been thrown at this management team. And here we are. And so continue to see growth here. That's good to see. As revenues increase at the box office, then this, and right, as we grow popcorn, as we grow food and beverage, as we grow merchandising, hopefully we'd continue to see the team keep a tight rein on operating expenses while revenues are growing. And then what happens is you're contributing more and more to our cash flows. Speaking of cash flows, our free cash flow, that is a metric. Adam's given you a few numbers. So there's this, I just told you about the contribution from operations. You can kind of find that on our statement of cash flows. And then you can find these guys will give you, Adam gives an EBITDA number. He gives a total, there's a total cash number, and then I'm giving you what's called free cash flow. So free cash flow kind of has to do with, as you're bringing in cash and paying bills, how much in the quarter was kind of what it sounds like sort of over and above all of that, and you could kind of have done with it what you wanted. There was this free cash. I'm under explaining that metric. Sometime we should probably go deeper. But anyway, so free cash flow, it's a very important metric, one I have measured from the beginning as well here. This scorecard, I haven't changed this since 2021. I've just kept it the same quarter after quarter. And so that helps us understand where we're going. This was only our fourth positive free cash flow post-pandemic. The first one was when Spider-Man No Way Home kind of just shocked everyone. Maybe it shouldn't have been a shock, but the size that it was so significant that you can go back Q4 of 2021. We actually had positive cash flow that early. That was a fun event. And I think what happened there really is AMC wasn't, full operation. So you probably had a little bit less operating expenses. And then suddenly you had this huge influx of revenue. So our free cash flow is positive. Then we had like I said, the 2 quarters. Actually, only the Barbenheimer quarter had free positive cash flow. Then this last Q4, we had, I believe, positive free cash flow. And then now. So you're starting to see a little bit more and a little bit more, especially if you take the strike out of the mix, then it's like, I don't know, I think it's 3 out of the last 4, or maybe 3 out of the last 5 non-strike quarters, we have positive free cash flow. That's a very, very good sign considering what a tough journey we've had. So we had $89 million positive free cash flow. That is a $168 million improvement year over year, and only the 4th time we've done that in the post-pandemic era. All right, so another one I look at now, this is back to the balance sheet, accounts payable and accounts receivable. So I've explained this, but I know I have a lot of new followers over the last couple months, so let me re-explain. Just think about when you owe somebody, like say you put something on your credit card, that is accounts payable. You have bought something, but you ran up a charge, but you haven't yet paid on it. You are going to need to pay that. That's accounts payable. Well, the thing is, if you put it on your all of a sudden I'm blanking out on the word, guys, on your tab. If you put it on your tab and you haven't paid yet, then you got to keep cash in your pocket. And that's why I'm measuring this, because this is related to our cash flows. And so what you're seeing is I'm measuring a variety of things, some about our profitability and some about our liquidity, because the whole point with the Jim Chanoses of the world and the Rich Greenfields of the world was we're not going bankrupt. Let me prove to you that our cash flow and our liquidity is improving as our profitability is also improving. So this is kind of more of a cash flow view again. All right, so if you have accounts payable, then you're delaying when cash goes out the door. Accounts receivable is the opposite. You are waiting for someone to pay you. You're waiting for the cash to come. So what you'll notice is our accounts payable went up $11 million year over year. Our accounts receivable went down $26 million year over year. That kind of helps with this free cash flow I just talked about. Basically, if we sped up getting cash paid to us, that's accounts receivable down, and we kind of managed how much is going out, that's accounts payable up, then you're supporting your cash flows. Now, Sean and his finance teams have boundaries here. There are ethical business practices. There are rules of accounting. There's, I'm sure, contractual agreements. A lot of times you have some things like a net 30 and there's certain discounts negotiated. You can have a certain amount of days to pay. You guys get it. I mean, you guys have a credit card. You know that you've got to pay every certain amount of days and all of that. Sometimes if you have certain types of bills, if you pay early, you get a discount. So the team is just managing our cash flow, and I continue to show you that. So basically this one, another green. All right, and then finally on our net loss or gain, I like, after all of this, I like to look at the bottom line. Adam's giving you an EBITDA number. I know why he's doing it. I think there's a lot of value in looking at that number. I like to look at our bottom line earnings. This is the bottom line, our net income or our net loss and gain. So we did show a $4.7 million loss on the quarter, but now I'll remind you, one of the reasons he's talking about EBITDA, the DA, is depreciation and amortization. That is a non-cash expense. So, I just told you we had positive cash flows, right? So you should be saying, if you haven't studied how to read these statements yet, you're going, wait a sec, I thought you told me we made money, which we did. We had positive cash flows of $89 million, positive free cash flow. And then I'm showing this loss. Well, the difference is you count some non-cash expenses. So I've shown you guys before, we have this NCMI thing, right? That's the advertisements that get shown, National Cinema Media. We have a non-cash expense to them of about $9 million every quarter. We have depreciation and amortization that's tracking around 80 million. It's a little less, probably like 77, 78 million the last quarter. And so you would see if you accounted for everything non-cash, then we really made money, right? So this is just for tax purposes. If we get to show a loss, we pay less taxes. And so just keep that in mind. But I do like to measure it as our bottom line. Where are we at? And so one of the reasons, of course, that Adam is reporting that EBITDA number is AMC has a lot of non-cash expenses. And so he's trying to help you see, another view of how we are improving our business. But, I want to be consistent. So I keep measuring that and showing you. Then you can see we improved $28 million year over year. But this is really important. So don't miss this. So lock in for just 1 minute here. Lock in, chat. Last year, this quarter, there were significant one-time events. We had a $108 million gain on extinguishment of debt. So what happened was and by the way, more than a year before this happened, I had told you guys, you can go find a video called The Pieces. I said that banks would be letting Adam pay off debt at a discount. And then it happened, right? So just maybe another kind of check on my credibility that I can tell you guys what's going to happen and then it happens. Well, what happened is when Adam's able to pay down debt at a discount, you have to count that as a gain for tax purposes. And so we showed a $108 million gain on the extinguishment of debt, meaning, at least in terms of accounting rules, we paid off debt at a $108 million discount. We paid off $108 million more debt than what it actually cost us to pay it. So that was great. That's a good thing. But that's a one-time event, and we're now comparing, this quarter versus last year at this time. And when you compare, you want to kind of take out one-time events because it's not really part of the ongoing business. Then we also had a lawsuit settlement last year. So sorry, combined, I should say, the gain on extinguishment of debt, the lawsuit settlement, those were kind of put in a line it's kind of an other income line last year that showed a really big positive that we don't have this year. So if you factor that in, I'm going to talk about that in a minute actually, but effectively, I guess I can just steal my own thunder. You get that if you take -5 and you add 108, that we improved our bottom line earnings more than $100 million year over year, if you kind of correct for that, if you take that out. All right, so let's talk about our bottom line here. In 1 year, we paid down, I said $709 million of debt. You can see that was a 702 here, right? So 702, I'll correct that typo in case I ever post that on X or something. We paid down $702 million in debt. I'm just saying we probably paid down some amount of deferred rent. I didn't go look up that number. And then remember that we have $143 million more debt that we paid off in July, which is going to show up in Q3. So fantastic. Our debt continues to go down. Yes, our attendance growth under-indexed the box office growth, but think about closures and retrofits that impacted attendance. And then, we talked about ticket price and food and beverage per person as major bright spots. I mentioned that our net income is up, more than $100 million. So here's this asterisk, right? More than $100 million if you take out those one-time events last year and compare apples to apples. And then don't miss that our EBITDA was up $160 million. Some of you have kind of teased me for how I say that. I don't know. It's just kind of how we said it at Nike. I suppose because at Nike we were measuring EBIT quite a bit. And so then the DA we would kind of, but I think others don't quite pronounce it that way. That's fine. Anyway, all right. So revenue continues to climb. Almost done with this, numbers, maybe boring slide for some of you. And then we're going to talk about a couple more. Revenues continue to climb while liabilities continue to decline. So I'm going to show you this next slide. And by the way, we are pretty much, actually, I think we were at an all-time retail era. Some of you ask what I mean when I say retail era. I'm just talking about, the apes kind of showed up January 2021 with Kitty and a lot of other things that were going on. And so in the ape era or the retail era, we have a record 12-month revenue versus our liabilities. Why don't I just show you that? Okay, so it's just something I was kind of taking a look at. If you look at a rolling 12 months of AMC's revenue, that's the green line you're looking at. And notice there's two axes here, right? So on the left, this is our total liabilities. And what I want you to notice is down, 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 down. AMC's liabilities going down. That's a good thing. That's the ongoing work of these guys to pay down debt, pay down deferred rent, and a few other items, and clean up our balance sheet, make us look a lot healthier. Okay. And then I just wanted to know, it's not necessarily like a super common metric. I just wanted to know for myself, how is the comparison between our 12 months of revenue versus our total liabilities? In theory, the more revenue you start getting, then the lower relatively your liabilities start looking. You know, like take Apple. If you go look at Apple's debt, it's something way bigger than AMC's, way, way, way bigger. And nobody's worried about it because Apple has so much revenue. They can easily manage, service their debt is kind of the way to call that. Netflix has like $15 billion of debt. AMC's under $4 billion now. So Netflix is, almost 4x AMC's debt. And nobody is out there really talking a lot about it because of the revenue model. So as our revenues climb, our liabilities in relative terms, and you can just see that visually, become less and less. And eventually, in a way, it's not a conversation anymore. We're not worried about it. Not that I've ever been worried, but the shills try to pretend like we should be worried, right? So what you'll see is, take a look at the 12-month revenue line. It kind of goes off the chart, right? That's because I've put a base here at $3.5 billion. So it doesn't even show up until the trailing 12 months is $3.5 billion of revenue. Well, you guys know 2020 was lockdowns, 2021 was barely recovering. So we don't hit that here until kind of mid 2022. And what you can just see is steep up and to the right. And this last quarter that was just reported, we had our record high. This was the biggest rolling 12-month revenues we'd had in the ape or the retail era. We almost got to 5 billion, which is pretty significant if you go back even and look at pre-COVID. So we're getting real high on our revenues. In the meantime, you just see how our liabilities down, 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 down. And then remember that out of this last bar here for the liabilities, I could take out another 143 million that's going to show up. So if I refresh this chart after Q3, our liabilities down again. And so that's going to continue to look real great. And then this is just one I'm going to put in my back pocket because especially as we get to Q4 and then 2026, remember what Adam's told you, remember what I've told you, we're going to start seeing real growth at the box office, some pretty significant numbers, and this revenue line is going to start continuing to climb. And then if we start using any cash from operations to actually pay down debt, you'll see these two start to get some real separation between them. I'm going to have to redo these axes, the minimums and the maximums, because our revenue is going to go up and our liabilities are going to go down, right? So that's just all I want you to see, that we're growing the thing we should grow and we're shrinking the thing we should shrink. And, speaking of which, this is a slide I showed recently in another video, so I'll go through it quickly, but in case you missed it, this was kind of evidence I was suggesting that the Go plan is working. Here are 3 similar box offices from 2018 and 2019. 2 of these in 2019, 1 of these in 2018. The orange line is showing you AMC's bottom line profits, and then the blue bars are the box office. So what you can see is we just completed a smaller box office than pre-COVID. Note that this blue bar is the smallest one, and yet the highest bottom line earnings. That's telling you what your management team has done with AMC, that on a lower box office, we have better earnings. Now, what do you think happens when this blue bar goes up? Let's say this Q4, and I think it'll, let's see, but this Q4 starts to be strong, and then in 2026, what happens when we have like Avengers, when we have Mando, we have another Mario, we have The Odyssey? You're going to have some really, really big movies in 2026. And so when this box office number goes up and then this earnings number starts skyrocketing because of that operating leverage, you should basically just be seeing in this chart that management's strategy is working. That's what I believe. All right. So, hey, quick plug for myself, and then we're going to come back to business So I'll try to do this quickly. I try not to do this very often, but I've had a lot of new followers lately. So I'd love to just tell you a tiny bit of even who I am and ways that if you want to support an ape, if you want to support this ape, here are ways you can do this. I get trolled when I say this, and I say that with a smile too, because you know what? I'll even go back. I'm not asking anything that I didn't do myself. In 2021, there were two apes I discovered who had written books. I bought their books and I reposted about them. I just think, why would we call ourselves a community and then trash someone for sharing their work, right? So I just don't feel guilty about sharing my work. Shills, you go ahead and attack me for it. You can rally the people who think that I should feel bad about sharing this, and we'll just both go our separate ways. So if you're new to following me, my name is Eric Thompson. I wrote a book called Strong Like Wildflowers. I had started this pre-COVID. You can see here on the screen, I published it in 2023. I'm very proud of it. I think it's inspirational. I think it's moving. I think it's very deep. And I think that many of you will find, hopefully, I believe you'll find hope and encouragement and have some fun reading this story. So if you want to support an ape, it's hard as an indie author to get known. And so it's a big, big deal if you want to buy this. And then in particular, it's anonymous to give it a rating. So you can see there's those star ratings there. Giving it, the industry will basically say anything of a rating kind of 3 and up is super helpful. So I'm pretty proud of how this is rated at a 4.6 right now. But, it's hard to get eyes on it. So if you want to support me, that's on Amazon. Also, I've said before, just think of the guy playing guitar on the corner. And sometimes people toss a tip in the tip jar or in the guitar case. If you ever want to throw a tip my way, like I said, I pulled 109 of those FTD files down from the SEC. That took me hours and hours. I do that for free, and I always will. But if you wanted to support me, then you can go drop a tip. I'm on this site called Buy Me a Coffee. There's stock retail there as well. Just appreciate support for me and for my time I'm spending. Hopefully it's providing value to you. All right, but that's enough about me. Let's get back to AMC. So just kind of a summary here of what I've kind of talked about, and then some things coming up from me. Our net income and our EBITDA, both with 9-figure improvements, $100 million improvements, when that net income is corrected for the one-time events last year that I talked about. Big, big growth, big, big improvements. Fantastic to see. We had all-time highs in spending per person. Adam and Sean had talked about also contribution per person, kind of profit per person being at an all-time high. Our food and beverage revenue was at an all-time high. Next quarter, we will get to reflect the paydown of at least $143 million of debt that happened in July. So that's going to be fun. And then coming up from me, so I'll do the Q3 forecast. I'm going to probably do separately the Q3 forecast, the Q4 forecast, and our 2026 outlook. So we'll have kind of a series of numbers videos coming up. I will just say on Q3, every year the box office slows down, in particular as kids go back to school in America. So at the end of August and into September, the box office slows down a bit. And so the shills like to use that moment to try to freak you out and get you focused on negative news. So I would just say, chill out. This quarter, Adam said there's some softness to it. I agree. However, it's still, I believe, over a $2 billion quarter, which used to be a real hallmark. For us to get to that level was a big deal. So even in a soft quarter, to be above $2 billion at the domestic box office, I would just look at it that way, that is a big deal. Remember that Spider-Man No Way Home quarter that I said we were celebrating? Well, that was I think just barely at $2 billion as a quarter. And now we're calling a soft quarter $2 billion. So we have moved the goalposts, and I mean that this time in a very positive way. We have increased our expectations. We are at a much stronger, much better place. So now to call a $2 billion quarter something lower, I think we're doing great. And so I am going to go ahead and give you the numbers. We won't put fluff to that. I'll give the real forecast, but don't let people FUD you. I think it's meeting my expectations. We're tracking close to what I forecast before the quarter started. And again, to call a $2 billion domestic box office quarter, maybe even 2.1 or so, a soft quarter is just a fantastic thing to get to do. It's almost a luxury at this point, considering where we've come from. And then remember, Avatar is coming, Wicked 2 is coming, The Running Man is coming, Zootopia 2, SpongeBob. There is so much in Q4. And let's go back and remember the liquidity number that I showed you. That AMC has the war chest, has the cash. We're fine. So no concerns there. We'll talk about it. I would just sort of shield proof yourself on that one. It's a little ridiculous that people want to freak you out over that. Obviously, they're sort of vampires. There's a sort of evil spirit to waiting until someone has a moment that you can spin negatively and then trying to pounce on that. That's just what they do. And I think it's pretty pathetic. And so we just arm ourselves with facts over FUD, and you know that we will win. So let's go.